In December 2025, two pension funds, Northern LGPS and Local Pensions Partnership, quietly completed the biggest single residential property deal in UK history. They bought the entire portfolio of PRS REIT, 5,478 single-family homes spread across 71 sites in England, Scotland and Wales, in a transaction valued at £1.1 billion. And they're not stopping there. The partnership has committed an additional £1 billion to expand that portfolio to more than 15,000 homes over the next 10 years. This isn't a one-off story. It's the clearest sign yet that the UK rental market is being handed from one type of landlord to a completely different one, and most renters haven't noticed yet. Let's break down exactly what's happening, who's behind it, and what it means for you. To understand why pension funds are moving in, you first need to understand who's moving out. In 2025, around 93,000 buy-to-let landlords left the UK rental market. That's up from approximately 65,000 who left across 2023 and 2024 combined. And data from the English Private Landlord Survey, published in late 2025, found that 31% of landlords plan to reduce their portfolio size, while 16% are considering selling all their rental properties within the next 2 years. So what drove them out? Three things hit at roughly the same time. First, the Renters' Rights Act. The Act received royal assent in October 2025 and came into force on 1 May 2026. It abolished Section 21 no-fault evictions, converted all assured short-hold tenancies into periodic tenancies, and stopped landlords from refusing pets unreasonably or discriminating against tenants with children or those on benefits. For small landlords with 1 or 2 properties, losing the ability to easily reclaim their home felt like too much risk to carry. Second, the tax changes. Since 2020, Section 24 of the Finance Act has stopped individual landlords with a mortgage from deducting their mortgage interest as an expense. Instead, they receive only a 20% basic rate tax credit, a rule that hit higher-rate taxpayers especially hard when interest rates climbed. Then, from April 2027, income tax rates on rental income are set to increase by 2 percentage points, announced in the autumn 2025 budget. Third, the energy efficiency rules. Under the Warm Homes Plan confirmed in January 2026, the minimum EPC rating for rental properties is rising to Band C for new tenancies first and for all tenancies by 2030. A large share of rental homes sit below that rating today, meaning real upgrade costs for landlords. For many, particularly those with older properties, those bills simply don't pencil out. Jason Harris Cohn of Landlord Buyer put it plainly at the end of 2025. He described the situation as a critical tipping point, saying the 93,000 who left in 2025 were just the start, with a wave of private landlords, particularly those with 1 or 2 properties, choosing to exit before risks increase further. New Savills figures show that 254,000 previously let buy-to-let homes were listed for sale in the 12 months to the end of March 2026, the equivalent of 697 properties per day. The amount of buy-to-let stock hitting the sales market has increased by 28% on 2024. In London, former rental properties now account for 30% of all new sales instructions, compared to just 13% across the rest of Great Britain. That's a lot of homes leaving the rental pool, and that gap has to be filled by someone. The answer is institutions, and the numbers are significant. Institutional investors, such as private equity firms and pension funds, spent a record £1.5 billion on single-family homes last year. That figure is expected to rise further in 2026. Industry forecasts anticipate just under 24,000 build-to-rent completions this year, with total investment expected to exceed £5.7 billion. The Northern LGPS and Local Pensions Partnership deal in December 2025 was the headline transaction, but there were others running in parallel. In February 2026, Border to Coast Pensions Partnership, the largest LGPS pool in the UK, managing over £110 billion in assets, committed more than £70 million to forward fund 139 single-family rental homes at Springstead Village in Cambridge. It was their first ever single-family housing investment. Korea's National Pension Service is also now actively involved, investing in UK single-family housing through a partnership with Long Harbour. And the private sector is just as active. Lloyds Banking Group now manages approximately 7,500 rental units, with a portfolio valued around £2 billion, and has an ambition to own 50,000 homes by 2030. The bank recently partnered with house builder Barratt Redrow to add nearly 600 homes across Berkshire, Kent and Cheshire. Blackstone, the world's largest real estate investor, has acquired 4,500 homes from Vistry in deals totaling £1.4 billion, and now oversees 17,000 residential properties across the UK. Why are pension funds so drawn to this right now? The answer is simple. Pension funds need stable, predictable returns over the long term, and rented housing, which is in chronic undersupply, provides inflation-matching income. Average gross yields for houses in the northeast currently stand at 7.2%, compared to 4.8% in London. Yorkshire, the northwest and Scotland all offer yields above 6%, making them attractive for investors seeking income-driven returns. Over the next 5 years, from 2026 to 2030, 50% of major house builders surveyed by Savills say they intend to sell more than 15% of their new home deliveries to single-family housing investors, a major shift from just 10% over the previous 5 years. The direction of travel is clear. The individual landlord is being replaced, not by the council, not by housing associations, but by pension funds and institutional capital. Here's the part that matters most for renters right now. The average rent for new lets in the UK as of June 2026 is £1,321 per month, a rise of 2.1% or £30 over the past year. That headline number sounds manageable, but it doesn't tell the full story. Rents are rising faster than the national average in 75% of local areas. There are 25% fewer rental homes on the market today than before the pandemic, and that structural shortage is keeping upward pressure on rents even as demand cools. According to Zoopla's data from May 2026, there are now an average of 5.6 inquiries for rental home, down from a peak of 16 in 2022. Competition has eased, but supply hasn't recovered. Average UK private rents reached £1,377 per month in March 2026, a 3.4% increase on the previous year, the lowest annual growth rate since March 2022, down from a peak of 9.2% in early 2024. The regional picture is striking. Rents are rising fastest in more affordable areas. Places like Carlisle are up 9.1% year-on-year, Kilmarnock up 9%, and Halifax up 6.5%. Meanwhile, in London, growth has slowed to just 1.7%. The pressure has shifted away from the big expensive cities and into smaller towns, where renters have fewer choices. Savills estimated that in the 3 years to May 2025, the private rented sector in England witnessed a net contraction of 354,000 homes. In that same period, the build-to-rent and institutional single-family sectors together added just 55,000 homes. That gap, over 300,000 homes, is the core of the problem. The 93,000 landlords who left in 2025 represent just 6% of all buy-to-let mortgage holders, but they triggered a 19% surge in households at risk of homelessness. This is where the conversation gets complicated. The CEO of Granger, one of the UK's largest corporate landlords, argued after the Renters' Rights Act came into force in May that fewer small landlords will make it easier for renters to find a home, that a more professional sector is simply better run. For context, institutional investors currently own just 3% of UK rental homes compared to 37% in Germany and 41% in the US. By international standards, the UK's institutionalisation of renting is still in its early stages. So here's where things stand in June 2026. The UK rental market is going through a structural change that's been building for years and is now moving fast. Private landlords are selling up in record numbers. Pension funds and institutions are stepping in with billions. Rents are still rising in most areas, supply is still short, and the full impact of this handover is still playing out. Whether that's a better deal for renters long-term, more professionally managed homes versus the flexibility of small landlords, is genuinely unclear. What is clear is that the market you knew 5 years ago looks very different from the one being built right now. If you're a renter, a homeowner, or someone watching this market, this is the shift worth paying attention to.